Core CPI rose 3%. We're getting those numbers in now, month over month, 0.2% for the month of September. For more on this, we are joined by Alex Grassino, our global chief economist for Manulife Wealth and Asset Management. Alan Small, of course, is with us as well. Okay, Alex, great to have you. I just want to get your reaction. This was below expectations, these numbers coming in. What do you make of 3%?
Thanks for having me on. The slightly lower than expected core CPI print that came in at 0.2% month over month is, in fact, a positive incremental piece of news for the Fed. It does mean that they will very much continue to ease next week. That was always going to happen. But for me, what the bigger story is how it is informing what will happen in December on a go-forward basis. At this stage right now, all signs are pointing towards the Fed being able to continue moving, and our base case is, in fact, for 225 basis point cuts between now and the end of the year.
So, Alex, I guess my question is, obviously, inflation is still 3% versus the 2% target that the Fed obviously would like to see. So I think the question we're all going to ask is 3% the new 2%? And, does the Fed actually think that inflation will get down to 2% as they continue to cut?
I think the short answer is not anytime soon, especially with tariffs moving around in the background. But when you listen to Fed Chair Powell's framework, as was laid out in August and September, I think essentially what he's done is given CPI permission to run a little bit warm, especially in certain key areas. What we're really keyed in on right now is services, ex shelter and energy, so super core inflation. That to us is a real tell on what inflation that can't be explained away is doing at this stage. And so far it's been running a little bit warm, but it is, I think, still within acceptable ranges for the Fed at this point.
Obviously, the U.S. shutdown is expected to affect data moving forward. Of course, this is for the month of September before that government shutdown went into effect. Is this the last accurate reporting that we're going to get for a while, maybe on the U.S. economy? Like, how important is this data we're seeing today, given what we've seen since September?
I think it's important to contextualize this kind of disruption. It's not that we haven't had disruptions in the past, and not just from government shutdowns. If you think about natural weather events, you do have data, but it might be distorted. I think effectively what happens is the markets look through it and they use the momentum that the economy has, or the trajectory that the economy has been on over the last several months, and extrapolate from there until there's any meaningful new data that you can reassess on.
So, with, I guess, the predictions that you're making another quarter point and then a quarter point after that, with the new Fed coming in, I guess, in the new year, would you think this would be a green light for the stock market? Like, should investors think of this, more cuts are coming this year, next year, with a new head of the Fed coming in? Obviously, they're going to have a dovish bias, I would imagine. Is this a green light for investors to continue to buy U.S. equities?
So I'm actually a little bit more cautious than the markets have priced in at this stage. And a large part of the reason for that is that this is still very much Fed Chair Powell's Fed, at least until the end of May. And what that means is if the U.S. economy is still moving along at a reasonably good pace, if the labor market holds, even if at soft-ish levels, and inflation does in fact pick up at some point, I think you could start to wonder about whether or not you get all the cuts that are priced in by the market now. That having been said, after May is a completely different story. At that point, we'd actually skew a little bit more dovish.
You say in your notes to us that you're not overly exercised about signs of inflationary pressure in tariff-sensitive areas. Can you elaborate on that? Because, of course, we're seeing that inflation in certain areas such as cars, toys, some areas that are not really impacted by tariffs.
I think from our perspective, the real read-through is, from a Fed perspective, whether or not the Fed will react to the data. And going back to what Fed Chair Powell had said at Jackson Hole and again in September, they're willing to look through the first round effects of the tariffs. Their base case is that it's a shock, which means prices will go up. By our modeling, not even all that much. And then they'll sort of revert back down within 1 to 2 years afterwards. So you don't want to use the T word, but transitory is sort of the way they're thinking about it, all while being careful about extending the effects of higher inflation. One thing that is complicating it a little bit is that tariffs are still a moving target at this stage. And what that means in practice is that it could take a little longer for the full effects of tariffs to pass through inflation.
Okay, Alex Grassino, Global Chief Economist at Manulife Wealth and Asset Management, joining us to break down these CPI data numbers that are coming out. Appreciate your time. Thanks so much for joining us.